Hello, welcome to the week ahead in charts. It's week 45, the 11th of November. My name is James Kim, one of the sales traders from Sydney, Australia, broadcasting live here in Asia Pac. We're going to be running through this week levels over the US dollar index. We do feel that it is primed for a bounce, a bigger bounce than what we're already seeing here in Asia. We'll look at some levels of the euro dollar, followed by cable, Aussie dollar, followed by the Aussie Kiwi, then the dollar yen in terms of indices, the traditional indices we generally look at, the Nikkei Futures, followed by the CFD over the US 500 and the ASX 200. In terms of commodities, we'll be looking at WTI crude, followed by copper, and then gold. The US dollar index continued to clock losses after reversing off our 99 target the previous week. The support we marked at 97.59 had zero impact as the sell down had no respect to any relevant levels. However, this week we may have the scope for a potential bounce back, or at least a temporary breather, should it attempt to trade lower off last week's lows. Now, we'd like 96.34 as the level to temporarily hold any further losses down to the lower channel trend line here, which coincidentally this week hovers above the 200-day moving average at 95.80. So those levels again to cautiously watch to the downside. It starts at 96.34 to 95.80. You can notice here that on the weekly chart, the US dollar retraces down to the upper pennant trend line that it broke a couple of weeks back, and this week this trend line happens to intersect the lower pennant trend line, giving us another indication that these levels here that are marked in the previous chart has another catalyst to hold. So we will have a keen interest upon the dollar index trading lower for the week should we get that scenario. The euro rallied on as we had anticipated and as outlined in last week's presentation, also penetrating through our weekly resistance level of 110.82. Now the euro continues to remain upside corrective, and we see some opportunities to fade this move. Not too far above last week's close sits the 200 daily moving average, which coincides with a 61.8% retracement between the August highs down to the recent lows. You can also see that there is a trend line as well that connects the swing highs all throughout August and September, giving you a perfect alignment of cluster of resistance at these levels. So we expect for a lot of heavy resistance and a lot of focus to be enjoyed at the 111.60 up to the test of this upper trend line here this week should we get a higher move over the euro. Now the launch we saw over cable in the past week was a significant move, as it had managed to trade through the June down to the September trend line, and it now has its eyes firmly fixed to test that July August previous support levels. Now it's interesting to see that these July to August support levels happens to be a 38.2% retracement between the pre-Brexit highs down to the recent lows. So we do expect some heavy resistance at this level upon continued gains. We saw a positive weekly close for the Aussie, and this week may serve as make or break, as it clearly wants to break out of those August to September resistance zones as defined on the chart. Now, I highlight that industrial metals across the board continues to trade firm, and we will be running through our view over copper in the next couple of charts, which will largely aid Aussie strength this week. The hurdle above these resistance zones starts at 78.10 up to 78.33, which was the 2016 high back in April. An unexpected sell down will find support along the blue trend line, which this week intersects the lower channel trend line here at 75.50. So strong buy opportunities would lie here if we get that peculiar move over the Aussie. The retracement in the Aussie Kiwi was deeper than originally expected, as the halfway mark between the September low to the October high failed to hold the pair slide last week. Now selling was arrested today at just below 104.17, which was a level that enjoyed a lot of traffic back in June, July and August, and we expect this level to now hold over the Aussie Kiwi. The next test will be a settlement above the 105 handle, but effectively we are now seeing a higher swing low and looking for the pair to trade firmer throughout this week. The dollar yen reached our final support level last week of 102.79 with a weekly settlement above here, which was an encouraging signal as it went into the close, and today we are seeing a massive risk on sentiment rally. Now the actual low that came in over the dollar yen happened to be a precise 50% retracement between the August lows up to the recent high, as you can see here, and it's imperative that this level holds this week and in the coming weeks. In anticipation of higher moves, we target the 105 handle as the first test to the top side, and in the unlikely event of a breach of last week's low over the dollar yen, the first level that is opened up isn't too far below here at 102.30, and below 102.30 we really don't have any major levels until 101.30, which is where I'm marking here on the charts. The Nikkei Futures found support on Friday at the intersection of the upper April to September trend line and at the lower June to September trend line at this very intersection here, and it's critical that this lower trend line here holds Nikkei's selling moving forward. An erosion of this trend line this week could force the Nikkei to challenge the 200 DMA. However, the support here upon this intersection does signal that perhaps it is now time the Nikkei is ready to re-challenge the 17,500 level, which would remain as mild resistance this week. US equities continued to slump in the past week, clocking its longest losing streak in close to 36 years. The close over the S&P 500 CFD was right on the 200 DMA on Friday, and today, upon quite a decent gap, trades at a key overhead resistance zone here, which were the support across September and in middle of October. Now it'll be interesting to see whether it can claim a victory above these levels here on the close today, which would set up the US equities for continued gains heading into the election. We also highlight that prices will be most likely be pressured under this trend line here. This week have quite an interesting retracement that we need to keep in mind. If we look at the retracement tool between the recent highs down to the lows that we saw on Friday, the 61.8% retracement level sits at the intersection of the upper downsloping trend line. So this would be an interesting area to watch for a rejection over any further gains over US equities. Big rally that was enjoyed today over the Aussie 200 after a continued suffering last week. Last week it also broke a key trend line support that should have held. That trend line starts in April, connecting through June and September. One can also argue that there is a head and shoulder formation here. The test for tomorrow will be the 200 DMA here, and at 5300, which is a whole number, sits exactly around the retest of this trend line that it broke. So we may see some selling pressure here. And it was relentless selling over crude last week as it smashed through our levels with the most critical support at the February to August trend line being violated. Now, we had expected for these trend lines to hold the slide last week. However, the selling pressure prevailed. Now, if we look at the daily chart, crude has found support just above the 200 DMA, and also this trend line that it broke above in September. In the event of a continued sell down, we don't really have much significant levels until the September swing low here, which is at 42.55, followed by August swing low here at 39.45, and a potential aggressive bounce could follow from here. But till then, we do expect it to continue to trade above this trend line here, above the 200 DMA for the week. Copper has now broken free from the consolidation zones as marked by the upper green trend line and the lower purple trend line, with its sight firmly on this year's peak at 232. Now we're going to continue to monitor for follow through. Above here, prices will be most likely be challenged at this long-term trend line, which starts in 2011, which is what I'm marking on the chart here. And this week, where it intersects this horizontal line that I've marked just above the 236 level, this is quite an interesting level, because back in 2007, after trading just above here, copper had experienced a very big rally. So we have an alignment of a long-term downtrend starting from 2011 to this significant level here, and that timeline comes in this week. Lastly, gold in the past week found its resistance at precisely a halfway retrace mark between this year's highs to the recent lows here. Now we are expecting gold to retrace lower following this this set of gains that we saw. We note that the 200-day moving average doesn't sit too far below from where it's trading here in Asia, and we do mark support here for the week at 1277. Upon a trade higher, and as it trades through 1308, which again is that 50% retracement between this year's highs to the lows, we mark this downtrend, which connects the higher swing highs across August and September. Also, the next set of resistance above 1308 would be 1323, which sits just below that trend line here for the week. That's pretty much it from the charts. Wishing everyone a profitable trading week ahead.